So what is the stock market anyway? From the outside, it looks super complex, right? But it's actually built on just a handful of really powerful, simple ideas. And that's what we're going to do here. We're going to break down those core pieces step by step to show you exactly how it all fits together. All right, here's the game plan. We're going to start our little investor's journey by figuring out what a stock really is. Then we'll crack its code, see where it's all traded, look at a smarter way to play the game, and finally, get to the bottom of what makes those prices jump around. So let's get started with Section 1, your piece of the pie.
Okay, first things first. Before we even get into all the talk about markets and prices, we gotta get a handle on the most basic building block of everything, the stock itself. The easiest way to think about it, it's your own personal slice of a company's pie.
And honestly, this is the key to the whole thing. When you buy a stock, sometimes you'll hear it called equity. You're not just buying some flashing number on a screen. No way. You are actually buying a tiny fractional piece of ownership in a real company. You literally become a part owner of that business.
But why? Why does this whole system even exist? Well, it's a two-way street. See, companies sell off these little pieces of themselves to raise money. We're talking cash they can use to grow, build new factories, or invent the next big thing. And what do you get in return? As a shareholder, you get a claim on that company's value. So if the company does well, your slice of the pie gets bigger and a whole lot more valuable.
And sometimes the perks are even more direct. Some companies, when they're making good money, will take a chunk of their profits and just hand it out directly to their shareholders. That's called a dividend. You can think of it as a little cash thank you check for being an owner. Okay, so you own a piece of a company. Awesome. But wait, there are thousands of them out there. How in the world do you find and identify the specific one you're looking for? Well, that's where the market's own special language comes into play.
Right, so every single company that's traded publicly has something called a ticker symbol. Just think of it like a unique ID code for a stock, or maybe even its DNA. It's just a short, memorable tag, usually 1 to 5 letters, that makes absolutely sure you're looking at the right company. And you can see just how simple and effective these things are. I mean, some of the most famous companies on the planet are known by just a few letters. Microsoft, that's MSFT. Coca-Cola, just KO. And Tesla is TSLA. See? That's the language of trading right there.
Now, this brings us to a super important pro tip for anyone starting out. Always double-check that ticker symbol before you hit buy. I'm serious. For example, the ticker for the car company Ford is just the letter F, but if you accidentally type out FORD, you'd be buying shares in a totally different company called Forward Industries. A tiny typo like that can be a huge mistake.
All right, so we know what a stock is, and we know how to find it using its ticker. But where does all the action happen? Where does the actual buying and selling go down? Let's dive into the modern-day marketplace. So the easiest way to picture a stock exchange is like a giant, super high-speed auction house. In the US, the two big ones are the New York Stock Exchange, the NYSE, which is home to a lot of those big, established blue-chip companies like Walmart. And then you've got the NASDAQ. That was the world's first all-electronic exchange, and it's famous for all the tech giants, your Apples and Amazons. But here's the thing. You and I don't just walk up to the NYSE and start trading. We need a gateway to get in. Back in the day, that meant literally calling a guy on a rotary phone. Today, your gateway is your brokerage, and that's usually just an app sitting right there on your phone. Think about it. Brokerages like Fidelity or Schwab, they're basically your agent. It's simple. You put money in your account, you tell the app what you want to buy or sell, and bam, they go out and execute that order on the exchange for you. Plus, they handle all the boring but important stuff, like keeping records and sending you your tax documents. And you should know, this is a very regulated system. All the legitimate brokerages are members of something called the SIPC. And what that does is it provides a really important layer of protection for your assets, just in case, in the super unlikely event that the brokerage firm itself goes under. Okay, so now that we've got the mechanics down, let's talk a little strategy. Because let's be real, putting all your eggs in one basket or all your money into one single company can be pretty risky. So instead of betting on just one horse to win the race, what if you could bet on the entire field all at once? And that, my friends, is the big idea behind diversification. Instead of making one giant investment, you can buy a fund that holds tiny little pieces of hundreds, even thousands of different companies. It's the classic safety in numbers strategy. If one company completely goes belly up, your overall investment barely even feels a bump. Now, the two most popular ways people do this are with index funds and something called ETFs. They're actually very similar.
Both of them just track a market index, like the S&P 500. The main difference, really, is how they trade. ETFs, that stands for Exchange Traded Funds, can be bought and sold all day long, just like a regular stock. Index funds, on the other hand, usually just trade once, at the end of the day.
So, we've covered the what, the who, and the where. But there is one final, absolutely massive question we've got to answer. What is it that actually makes a stock's price go up or down?
I mean, this is it. This is the force that drives everything. It's the engine of the entire market. And the answer? Well, it's surprisingly simple.
It all boils down to a constant tug of war, a battle between supply and demand. Think about it. If more people want to buy a stock, that's high demand, then there are people who want to sell it, that's low supply, then the price has nowhere to go but up. And on the flip side, if way more people are selling than buying, the price drops. That's it. Every single news report, every earnings call, every shiny new product, it all gets filtered through this one simple dynamic.
So there you have it. We've gone from a single share of a single company all the way to the epic forces that move the entire market. See? It's not just a bunch of random numbers flashing on a screen. It's a living, breathing system of ownership, language, and, really, human emotion. So now that you know the building blocks, the next time you look at the market, what are you going to see?